The greatest scam in science history. Why investors kept funding the impossible. What if the most persistent lie in the history of science was not created by fraudsters, but financed by intelligence, education, and good intentions? What if generations of investors did not lose money because they ignored science, but because they believed it was incomplete? The perpetual motion machine was never just a technical idea, it was an economic promise disguised as a scientific breakthrough, and for centuries it attracted money with remarkable consistency. The claim was simple and absolute: a machine that produces continuous motion without external energy input, no fuel, no exhaustion, no limit. For investors, this was not a philosophical curiosity, it was the ultimate asset. A device that could run forever meant production without cost, profit without depletion, and dominance without competition. The machine did not need to exist yet, it only needed to be possible. From the earliest records, designs for perpetual motion appeared wherever mechanical knowledge was incomplete. Wheels powered by their own weights, water flowing uphill to feed itself, magnets arranged to spin endlessly. These were not crude fantasies. Many were proposed by respected engineers and natural philosophers. In an era before formal energy laws, there was no definitive language to declare them impossible. Uncertainty created opportunity, and opportunity attracted capital. Patrons funded these machines, not as speculation, but as inevitability. Failure was explained as a technical flaw, not a conceptual one. Each unsuccessful prototype reinforced the belief that success was close. The logic was circular and powerful. If so many intelligent people were working on the problem, it must be solvable. Money flowed not toward evidence, but toward effort. What sustained the belief was not results, but framing. Perpetual motion was presented as discovery delayed, not fantasy disproven. Inventors emphasized complexity, investors interpreted difficulty as depth. The absence of success was never treated as a warning sign. It was treated as proof that the breakthrough would be revolutionary when it finally arrived. By the time formal physics began to emerge, the idea was already financially embedded. Workshops had been built, patents had been filed, reputations had been attached. Walking away was no longer a rational option. To abandon the machine meant admitting that years of funding, endorsement, and belief had been misplaced. Losses were easier to tolerate than error. Crucially, perpetual motion did not survive by rejecting science. It survived by positioning itself just beyond science's current reach. Every time a principle was established, proponents claimed an exception. Every time a limit was defined, they insisted it applied only to conventional systems. Investors were told that true innovation always looks impossible at first. History was selectively cited. Skepticism was reframed as lack of imagination. This is how the machine endured, not through deception alone, but through hope reinforced by authority. Engineers lent credibility, patrons lent capital, institutions lent legitimacy. Each layer insulated the idea from scrutiny. The question was no longer whether the machine worked, but who was willing to believe it would. Over time, the promise of perpetual motion became detached from any specific device. It evolved into a narrative that nature contained a hidden surplus waiting to be unlocked by the right mind. Investors were not funding machines anymore. They were funding the possibility of escaping limits altogether. And that belief, once established, proved stronger than evidence, stronger than failure, and stronger than time. Long before physics learned how to say no, money had already said yes. The consequences of that decision would unfold slowly, repeatedly, and predictably. Not because the idea was convincing, but because it was irresistible. What followed was not a single scam or a single collapse. It was a pattern, and once that pattern took hold, it stopped needing machines to survive. The belief did not spread because people were irrational. It spread because at the time, there was nothing precise enough to stop it. Before physics defined energy, motion appeared negotiable. Machines moved, water flowed, weights fell, heat appeared and disappeared. No unified framework existed to explain where motion truly came from or why it always faded. In that gap, perpetual motion did not look impossible. It looked unfinished. Early designs followed a consistent logic. If motion could be sustained briefly, it could be sustained indefinitely. If a wheel could turn under gravity, it could be arranged so gravity never stopped acting. If water could descend, it could be guided to rise again. These ideas were not dismissed as fantasy. They were documented, replicated, and refined. Some appeared in scholarly manuscripts. Others were demonstrated in workshops. None worked for long, but duration was treated as an engineering problem, not a conceptual failure. Inventors operated in an environment where boundaries were unclear. There was no law stating that energy could not be created from nothing. There was no equation to measure unavoidable loss. Friction was observed, but not fully understood. Heat was seen as a byproduct, not a cost. In this context, perpetual motion was not an outlier. It was one of many unresolved questions in natural philosophy. Money entered early and quietly. Patrons funded these machines as strategic investments. A successful design promised not only wealth, but political leverage. A device that ran forever could power mills, pumps, or weapons without supply chains. States funded experiments indirectly. Courts employed engineers who pursued the idea alongside legitimate work. Failure was tolerated because the prize justified patience. Records from this period show a repeating pattern. An inventor would present a mechanism that appeared to move continuously under observation. The demonstration would be brief, controlled, and impressive. Backers would fund refinement. The machine would eventually slow, stop, or reveal a hidden input. The inventor would adjust the design and request more time. The funding would continue. What sustained the cycle was not deception, but interpretation. When a device failed, it was not taken as proof against the concept. It was taken as evidence that the solution lay just beyond current skill. Complexity increased with each iteration. Simple wheels became layered systems of weights, pulleys, and channels. Each added component created plausible deniability. If no one could fully understand the mechanism, no one could confidently dismiss it. Crucially, there was no institutional process to end the discussion, no standardized testing, no requirement for sustained output over time. Success was judged visually, not quantitatively. A machine that moved for minutes could be described as fundamentally different from one that moved for seconds. Language filled the gaps left by measurement. As investment accumulated, belief hardened. Abandoning the pursuit meant admitting that earlier decisions were wrong, that reputations had been misjudged, that money had been wasted. Continuing was safer than stopping. Each new design justified the previous one. Each new failure was framed as progress. This was the environment in which perpetual motion embedded itself, not as a fringe idea, but as a respectable problem awaiting resolution. Long before science could reject it, the idea had already learned how to survive scrutiny. It learned how to absorb failure without collapsing, and most importantly, it learned how to turn uncertainty into justification. The absence of limits did not create endless motion, it created endless belief, and belief, once financed, began to shape the rules of evaluation themselves. The moment science tried to impose boundaries, it would discover that the machine had already adapted to something far more resilient than ignorance. At a certain point, perpetual motion no longer needed to convince skeptics. It only needed the right names attached to it. Authority became a substitute for proof. An endorsement replaced verification. The machines did not work reliably, but the people promoting them mattered more than the results. Court engineers, academic scholars, and well-connected inventors played a central role. Many were competent professionals in other fields. Their reputations were real. When they supported a design, investors assumed due diligence had already been done. Very few asked for independent testing. Trust flowed downward. If an engineer advised a noble, and a noble funded the project, the public assumed legitimacy had been established. This pattern repeated across regions and decades. A machine would be presented not as a finished product, but as a state-backed experiment. Demonstrations were conducted in controlled settings, often supervised by respected figures. Observers reported motion, rotation, or balance that appeared to sustain itself. Reports emphasized novelty, not duration. Authority figures signed letters, published notes, or allowed their names to be cited. That was enough. Institutional structures amplified the effect. Early academies and learned societies were not designed to reject ideas systematically. Their purpose was discussion, not enforcement. When a proposal arrived under the sponsorship of a respected patron, it was debated, not dismissed. Silence was interpreted as acceptance. Delay was mistaken for validation. Patents added another layer. Governments granted protection for mechanical novelty, not for physical feasibility. A patent document looked official. It carried seals, signatures, and dates. Investors interpreted this as confirmation that the device had passed scrutiny. In reality, no such scrutiny existed. The system rewarded originality, not functionality. Authority also discouraged criticism. Challenging a machine meant challenging the credibility of those who endorsed it. Younger scholars avoided confrontation. Financiers deferred to titles. Skeptics were labeled narrow-minded or hostile to progress. The social cost of doubt increased with every endorsement. This dynamic insulated the idea from collapse. When a device failed publicly, blame shifted to execution. When it failed privately, it remained unknown. Authority figures rarely faced consequences. They had lent credibility, not guarantees. Investors absorbed losses quietly, hoping the next iteration would succeed. Over time, authority stopped functioning as a filter and became a multiplier. Each endorsement attracted more capital, which attracted more endorsements. The machine's value rose not because it worked, but because important people believed it might. The question investors asked was no longer whether perpetual motion was possible. It was whether they could afford to be excluded if it was. By the time scientific objections grew stronger, the network of authority was already dense. Titles, patents, and institutional silence formed a shield. The idea had become socially protected. Disproving it meant confronting not just a machine, but a hierarchy. This was the moment when perpetual motion crossed a critical threshold. It was no longer sustained by ignorance alone. It was sustained by reputation. And once belief is reinforced by authority, evidence stops being the deciding factor. The machine had found a way to survive without ever needing to work. The earliest investors in perpetual motion did not see themselves as gamblers. They saw themselves as patrons standing at the edge of history. Funding an eternal machine was framed as foresight, not risk. The logic was straightforward. If motion without fuel was possible even once, the economic consequences would be absolute. Energy costs would collapse. Production would decouple from resources. Whoever financed the breakthrough first would control what followed. Money entered the process long before proof. Inventors rarely arrived with finished machines. They arrived with mechanisms that almost worked, a wheel that turned longer than expected, a system that appeared balanced yet moved, a device that ran just long enough to be demonstrated under supervision. Investors interpreted these moments not as anomalies, but as evidence of proximity. The breakthrough was always described as one modification away. Contracts from this period show a consistent structure. Funding was released in stages. Initial capital paid for materials and workshops. Additional capital was promised after refinement. Failure did not void agreements. It triggered revisions. Inventors were rewarded for persistence, not results. The incentive was to continue searching, not to conclude. What made withdrawal difficult was not just sunk cost, but expectation. Early backers often persuaded others to join. Family members, business partners, and political allies were invited to participate. Investment became social. Admitting doubt meant admitting responsibility for convincing others. Silence was easier than reversal. Inventors learned to manage this psychology. They framed obstacles as indicators of depth. The more difficult the problem appeared, the more valuable the solution seemed. Technical delays were described as necessary for precision. Each request for additional funding came with new diagrams, new terminology, and renewed confidence. The machine itself became secondary to the narrative surrounding it. Importantly, early investors did not demand long-term demonstrations. Short-term motion was treated as proof of principle. Continuous operation was always scheduled for later. The timeline remained flexible. Success was perpetually imminent. As long as the device moved at all, the concept was considered alive. This environment created a specific type of belief. Investors were not convinced that perpetual motion worked. They were convinced that someone would eventually make it work. That distinction mattered. It shifted evaluation away from evidence and toward probability. Even a small chance of success justified continued funding because the payoff was assumed to be unlimited. By the time doubts emerged, they were internalized rather than expressed. Questioning the premise meant questioning judgment, status, and credibility. Investors who exited early rarely publicized their reasons. Losses were private. Optimism remained public. This imbalance distorted perception. Failures disappeared. Hope accumulated. The result was a self-reinforcing system. Early capital enabled further experimentation. Further experimentation justified early capital. No clear endpoint existed. The search continued not because success was likely, but because stopping required an admission no one was prepared to make. This was the foundation on which perpetual motion financing stabilized. Not on proof, but on commitment. Once belief became an investment, abandoning it felt more costly than sustaining it. And at that point, the machine no longer needed to function. It only needed to remain unfinished. The moment science began to define limits, the perpetual motion machine should have disappeared. Instead, it became more active. As physics matured, the idea did not retreat. It repositioned itself just beyond whatever science could currently explain. The introduction of formal mechanics and, later, thermodynamics established something dangerous for the machine: boundaries. Motion was no longer mysterious. Energy could be measured, losses could be calculated, heat, friction, and resistance were no longer inconveniences. They were unavoidable. The conclusion was clear. A machine could not produce continuous motion without continuous input. The accounting no longer worked. But this clarity arrived too late. By the time conservation principles were articulated, perpetual motion was already embedded in money, reputation, and expectation. Declaring it impossible did not erase the investments that had been made. It threatened them. And when belief becomes financially exposed, it does not surrender quietly. Inventors adapted immediately. Designs were no longer presented as violations of physical law, but as exceptions to it. New language appeared. Hidden forces, undiscovered interactions, boundary conditions science had not yet formalized. Physics, investors were told, was still incomplete. History supported the claim. Many breakthroughs had once been dismissed. Being told this cannot work became a selling point. Scientific rejection did not eliminate funding. It filtered it. Those who remained were not persuaded by consensus. They were motivated by contradiction. If the laws said no, then success meant rewriting the laws. That possibility carried status as well as profit. Financing perpetual motion was reframed as intellectual rebellion rather than technical pursuit. Institutions struggled to respond. Scientific bodies could publish objections, but they had no authority to enforce belief. They could explain why a device failed, but they could not prevent new claims from emerging. Each refutation applied to a specific design. Proponents simply introduced another. The argument reset every time. This created an asymmetric conflict. Science required proof to accept a claim. Perpetual motion required only doubt to persist. Investors were not asked to prove the machine worked. They were asked to believe that science might be wrong. That threshold was far lower. As rejection became more explicit, demonstrations became more theatrical. Devices were shown briefly, under selective conditions. Measurements were avoided. Observers were impressed with motion, not duration. Failures were attributed to testing environments. Success was always just outside the laboratory. Ironically, scientific opposition increased the machine's appeal. Being dismissed by experts reinforced the narrative of suppression. Investors were told that established scientists were protecting orthodoxies, not truth. The machine was no longer just a device. It was a challenge to authority. Funding it became an ideological statement. This phase marked a turning point. Perpetual motion no longer relied on ignorance. It relied on conflict. The clearer the laws became, the more valuable it was to claim an exception. Impossibility became marketing. From this point forward, the machine was not chasing acceptance, it was chasing contradiction. And as long as science continued to define limits, the promise of breaking them remained financially attractive. The lie did not weaken under scrutiny, it learned how to survive it. Once impossibility became explicit, simplicity disappeared. Designs that had once relied on a single wheel or channel evolved into dense assemblies of gears, counterweights, springs, magnets, and sealed chambers. The change was not driven by progress. It was driven by survival. Complexity became the primary defense. Early machines could be disproven quickly. Losses were visible. Motion decayed in plain sight. Complex machines behaved differently. They obscured causality. When rotation slowed or stopped, there were too many variables to isolate. Friction could be blamed on alignment, heat on materials, resistance on measurement error. Each added component created another excuse. Inventors learned to speak in layers. Technical explanations were long, precise, and difficult to verify. Schematics emphasized interactions rather than outcomes. Demonstrations focused on moments of motion rather than sustained operation. Observers left with the impression of sophistication, not clarity. Investors confused difficulty with depth. This shift altered the evaluation process. Previously, a machine failed when it stopped. Now it failed only when every subcomponent was fully understood and disproven. That standard was rarely met. Skeptics could identify weaknesses, but they could not close the case. There was always one more adjustment, one more configuration, one more test to be run. Complexity also protected reputations. When a device failed, blame could be distributed. No single flaw was decisive. Engineers could argue that the principle was sound, but execution imperfect. Investors accepted this framing because it preserved the value of prior commitments. A complicated system justified prolonged funding. Financial structures adapted accordingly. Proposals emphasized research phases, not deliverables. Budgets covered refinement, iteration, and optimization. Timelines expanded. Success was defined as incremental improvement, not functional completion. A machine that never worked could still be described as advancing. Language played a critical role. Technical terms multiplied. New categories were introduced to distinguish these devices from earlier failures. Losses were reframed as inefficiencies to be minimized. Energy input was described as activation rather than supply. Accounting blurred. Precision disappeared. Patents continued to reinforce the illusion. Applications grew longer and more technical. Examiners assessed novelty, not feasibility. Approval validated the appearance of innovation. Investors interpreted legal recognition as scientific endorsement. The gap between documentation and reality widened. Complexity also discouraged independent testing. Few had the expertise to evaluate the full system. Fewer still had the resources. Demonstrations remained controlled. Measurements were selective. When doubts arose, they were buried in detail. Exhaustion replaced analysis. By this stage, perpetual motion no longer needed to convince experts. It needed to overwhelm them. The more complicated the machine, the harder it was to dismiss quickly. Time worked in its favor. Each delay extended funding. Each unanswered question preserved hope. This was not accidental. Complexity was not a byproduct of ambition. It was a strategy. A simple lie can be disproven. A complicated one can persist indefinitely. And as machines grew more elaborate, belief became less dependent on outcomes and more dependent on endurance. The device did not need to run forever. It only needed to keep running explanations. At some point, perpetual motion stopped being evaluated as a machine and started being evaluated as a probability. Investors no longer asked whether a specific device worked. They asked whether it was statistically plausible that someone somewhere would eventually succeed. That shift changed everything. The logic was deceptively rational. If hundreds of inventors across centuries had attempted the same idea, failure did not look like refutation. It looked like persistence. Each new attempt was framed as an independent trial. Losses were distributed across time, while success, if it ever came, was imagined as singular and absolute. One working machine would erase every previous failure. That assumption made continued investment feel reasonable. This is where psychology replaced engineering. Investors became trapped by cumulative commitment. Money already spent could not be recovered, but it could be justified. Walking away meant accepting loss. Staying meant preserving hope. The longer the search continued, the harder it became to stop, because stopping required admitting that the original premise might have been flawed. Inventors understood this dynamic well. They emphasized proximity rather than progress. Each update was presented as narrowing the gap. Small changes were described as breakthroughs. Setbacks were framed as data. Investors were told that failure was informative, not discouraging. The language of research replaced the language of results. Social pressure reinforced the trap. Investors rarely acted alone. Partnerships, families, and institutions pooled resources. Withdrawal risked more than money. It risked reputation. Those who expressed doubt faced subtle consequences. They appeared impatient, short-sighted, unwilling to support innovation. Optimism became the safer public position. Stories amplified the effect. Anecdotes circulated about near successes, secret demonstrations, and suppressed results. These stories rarely included verifiable details, but they served a purpose. They suggested that failure was not universal, only incomplete. Each rumor reset expectations. Each reset justified another round of funding. Crucially, investors misunderstood risk. They treated perpetual motion as a high-risk, high-reward venture. In reality, it was a zero-reward system disguised as variance. The outcome space was not wide. It was fixed. But as long as that fact remained psychologically obscured, capital continued to flow. This trap was self-sustaining. New investors entered, replacing those who quietly exited. Losses were absorbed privately. Hope remained visible. The market never saw a clear signal of failure because failure was never collectively acknowledged. Each investor believed others still believed. By this stage, belief no longer depended on machines at all. It depended on other believers. Confidence became circular. The value of the idea rested on the assumption that someone else would continue to fund it. As long as that assumption held, the system functioned. This was the moment when perpetual motion achieved stability. Not scientific stability, but financial stability. The machine had embedded itself in human behavior. It no longer needed to defy physics. It only needed to exploit the way people process loss, hope, and possibility. Once that threshold was crossed, the pursuit could continue indefinitely. And it did. Not because success was likely, but because abandoning belief had become psychologically more expensive than sustaining it. By the time perpetual motion reached institutional maturity, it no longer relied on persuasion alone. It relied on procedure. Patents, exhibitions, and staged demonstrations created the appearance of validation without ever requiring performance. The system did not need the machine to work. It needed the process to look complete. Patents were central to this transformation. Governments issued them to protect novelty, not truth. An inventor was required to describe a mechanism, not prove it obeyed physical law. Approval followed paperwork, diagrams, and fees. Once granted, a patent looked authoritative. It carried dates, seals, and official language. Investors treated it as certification. In reality, it was administrative recognition, not scientific approval. Inventors exploited this confusion deliberately. Patent filings were written to emphasize originality while avoiding measurable claims. Energy sources were described indirectly. Losses were omitted or minimized. The documents created the impression of rigor without exposing the design to falsification. Once issued, the patent became a financial asset. It could be licensed, sold, or used to attract capital, regardless of whether the machine ever functioned. Public demonstrations reinforced the illusion. Devices were shown in short intervals under controlled conditions. Motion was emphasized, duration avoided. External inputs were concealed or redefined. A hand adjustment became calibration. Stored energy became initialization. Observers were not permitted to dismantle the machine or test it independently. What mattered was the moment, not the outcome. These demonstrations were not random. They were carefully staged to produce ambiguity. A wheel that turned for several minutes appeared fundamentally different from one that turned for seconds. No baseline was provided, no comparison offered. Without context, motion itself became persuasive. Institutions enabled this ambiguity. Exhibitions and scientific gatherings prioritized novelty and discussion over verification. A device that drew attention was considered successful. Failure was quiet. Success was visible. Reports focused on what was observed, not what was sustained. Language did the rest. Investors rarely demanded long-term trials. Continuous operation over days or weeks would have ended the debate, but such trials were never required. Inventors argued that extended testing risked damage or misinterpretation. Sponsors accepted this reasoning because it preserved optionality. As long as definitive failure was avoided, belief remained viable. Legal recognition compounded the effect. Courts treated patents as property. Contracts were enforced. Financial arrangements proceeded as if functionality were inevitable. The system rewarded the appearance of progress. It penalized conclusiveness. This environment produced what can only be described as controlled miracles. Machines that appeared to defy limits briefly, selectively, and under supervision. Each demonstration reset expectations. Each patent extended the timeline. The idea survived not because it worked, but because it never had to fail publicly. By now, perpetual motion was no longer an engineering challenge. Well, it was an administrative one. As long as documents could be filed, demonstrations staged, and belief maintained, the machine could continue to exist without ever producing what it promised. The question was no longer whether the machine could run forever, it was whether the system supporting it could. The illusion began to crack when perpetual motion stopped being debated in workshops and entered court records. Lawsuits forced claims into writing, promises had to be quantified, vague language became liability, disputes followed a pattern, an inventor accepted funding under explicit conditions. Deadlines were set, demonstrations were promised. When results failed to appear, investors sued. For the first time, perpetual motion was not judged by curiosity or optimism, but by contractual obligation. The question was no longer whether the idea was inspiring, it was whether it had been misrepresented. Court documents stripped away ambiguity, judges demanded definitions. What counted as independent operation? What constituted external energy? What duration qualified as success? Inventors struggled here. Claims that sounded impressive in lectures collapsed under cross-examination. Words like activation, balancing, or assistance lost their protective vagueness. Expert witnesses changed the tone entirely. Physicists were not asked to speculate. They were asked to explain constraints. Conservation laws were presented not as opinions, but as boundaries established through repeated measurement. The argument shifted from possibility to probability, not whether a machine might work, but whether there was any mechanism by which it could. Inventors responded predictably. They argued suppression, bias, outdated theory. They claimed their work existed outside established frameworks, but in court, novelty was not a defense. Evidence was, and evidence required numbers, not narratives. Financial records became decisive. Courts examined where energy actually entered the system: stored springs, compressed air, hidden weights, external adjustments. In several cases, devices were dismantled under supervision. Once isolated, the machines behaved exactly as physics predicted. Motion decayed, output matched input, the miracle vanished, judgments followed, contracts were voided, funds were reclaimed where possible. In some cases, fraud was established. In others, incompetence. The distinction mattered legally, but not financially. Investors lost money either way. These cases did not end the pursuit, but they changed its structure. Claims became more cautious. Language softened. Guarantees disappeared. Inventors learned to avoid binding promises. Perpetual motion retreated from enforceable commitments and returned to suggestion. Science, however, gained something critical. Courtroom scrutiny forced clarity. What had been debated abstractly was now documented concretely. Each case added precedent. Each ruling narrowed the space for ambiguity. The system began to recognize a pattern, yet belief did not collapse. It adapted. Losses were reframed as isolated incidents. Failed inventors were labeled dishonest or unskilled, not representative. The core idea remained untouched. The possibility was preserved by distancing it from its practitioners. What these trials revealed was not just technical impossibility, they revealed a structural flaw in belief itself. As long as failure could be personalized and success abstracted, the idea could survive any number of verdicts. The courtroom exposed the machines. It did not yet expose the lie that sustained them. When scientific institutions finally drew a hard line, it appeared decisive. Leading academies issued formal statements declaring perpetual motion incompatible with established physical law. Journals refused submissions. Patent offices in several countries introduced explicit bans on examining such devices. On paper, the question was settled. In practice, nothing stopped. The institutional response was precise and narrow. Academies did not prosecute belief. They regulated participation. A perpetual motion machine could no longer be presented as science, but it could still be presented as innovation. The distinction mattered. Science requires falsifiability. Innovation only requires promise. Patent offices revised procedures, but not expectations. Applications were rejected if they explicitly claimed perpetual operation. Inventors adapted instantly. They stopped using the term. Machines were rebranded as ultra-efficient, self-sustaining, loss minimized, or externally triggered. The underlying claim remained unchanged. Only the language shifted. Universities distanced themselves publicly while benefiting privately. Research grants avoided forbidden terms, but funded adjacent concepts. Energy recovery, resonant systems, nonlinear dynamics, each provided a conceptual shelter. Perpetual motion no longer stood alone. It hid inside legitimate fields. Scientific rejection also produced a counter-narrative. Institutions were portrayed as conservative, slow, and self-protective. Historical examples were selectively cited. Innovations once dismissed, later accepted. Context was ignored. Differences were blurred. The lesson was simplified into a slogan. Science has been wrong before. This argument appealed directly to investors. If institutions could err, then exclusion became evidence of originality. Rejection signaled disruption. A machine denied a platform gained mystique. The absence of peer review was reframed as proof of threat. Distance from authority increased perceived value. Media played its role. Coverage emphasized conflict. Lone inventors versus establishments. Brave outsiders challenging orthodoxy. Technical details were minimized. Narratives were maximized. Viewers were not asked to evaluate physics. They were asked to choose sides. Institutional scientists underestimated this effect. Their statements were accurate, but unemotional. They spoke in constraints, not stories. They addressed mechanisms, not motivations. In a marketplace driven by belief, that was insufficient. What changed most was the audience. Perpetual motion stopped targeting physicists. It targeted financiers, entrepreneurs, and the public. Evaluation criteria shifted accordingly. Scientific impossibility mattered less than market appetite. As long as capital existed outside institutional control, the idea had room to operate. The rejection clarified one thing: science could close its doors, but it could not close the market. The machine no longer needed academic legitimacy. It needed attention, funding, and time. By formalizing impossibility, institutions assumed the debate would end. Instead, they unintentionally completed the transformation. Perpetual motion was no longer a scientific claim. It became a cultural one. And cultural claims do not collapse under equations. The 21st century did not resurrect perpetual motion. It optimized it. Digital tools gave the illusion of progress. Computer simulations replaced physical prototypes. Losses could be hidden inside models. Friction could be adjusted away. Energy flows could be visualized without being measured. A machine that failed in reality could succeed on a screen indefinitely. Inventors no longer needed workshops. They needed renderings. Animated diagrams showed flawless motion loops. Graphs displayed stable output curves. Viewers were not shown equations, they were shown results. The absence of physical constraints made the designs look inevitable. Crowdfunding platforms accelerated the cycle. Funding no longer depended on a few wealthy backers. It depended on thousands of small contributions. Each contributor bore minimal risk and minimal responsibility. No single investor demanded proof. Collective belief replaced due diligence. Campaigns followed a familiar structure: a bold claim, a personal story, a promise of disruption. Technical sections filled with terminology, but no balance sheets of energy. Updates focused on progress, not verification. Delays were normalized. Setbacks were reframed as refinements. Modern inventors also borrowed credibility strategically. They cited real scientific concepts out of context. Quantum effects, vacuum energy, nonlinear resonance, chaos theory. Each term was real. Each application was wrong. The goal was not explanation, it was insulation. Critics now needed advanced expertise just to respond. Regulatory gaps widened the opportunity. Small devices avoided oversight. Prototypes were exempt from performance standards. As long as no electricity was sold into the grid, claims remained largely unregulated. Enforcement lagged behind promotion. Social media completed the transformation. Algorithms rewarded novelty, not accuracy. Videos of spinning devices spread rapidly. Corrections did not. Skeptical analyses were longer, less visual, and less shareable. Belief traveled faster than refutation. Crucially, modern promoters avoided absolute claims. They did not say infinite energy. They said unprecedented efficiency. They did not promise zero input. They promised recovery, amplification, optimization. Each phrase preserved deniability. Each avoided falsification, yet the mathematics never changed. Conservation laws remained intact. No simulation produced net energy when fully constrained. No prototype survived independent testing. Every success reduced to stored energy, external input, or accounting tricks. The outputs matched the inputs, always. What made this era different was scale. Losses were smaller per person, but larger in total. Accountability diffused. When projects failed, they faded quietly. New ones replaced them instantly. The idea did not need to persist, only the cycle did. By now, perpetual motion had fully detached from engineering. It existed as a pattern: claim, fund, delay, disappear, repeat. Each iteration borrowed legitimacy from technology itself. If computers were powerful enough to simulate universes, why not solve energy? This was the final camouflage. The lie no longer looked like ignorance. It looked like optimism powered by tools people trusted, and that trust made the old impossibility feel newly unresolved. The machine still did not work, but the system around it had never been more efficient. The final mistake was assuming perpetual motion survived because people misunderstood physics. That explanation is comforting. It is also wrong. Across centuries, the technical argument was settled repeatedly. Energy conservation was not obscure. Loss mechanisms were measurable. Independent testing always produced the same result. The impossibility was not hidden. It was ignored. And it was ignored for a reason. Perpetual motion did not persist because investors believed the machine could work. It persisted because they believed the system around it could pay off. At every stage, the device functioned less as a generator and more as a financial instrument. It converted uncertainty into opportunity. It transformed ignorance into leverage. Early investors were not buying energy. They were buying priority: patents, licensing rights, exclusivity, narrative control. The value proposition was never watts. It was position. Inventors rarely needed success. They needed plausibility long enough to extract capital, attention, or protection. Each machine acted as a temporary anchor. While it existed, money could move. Once it failed, responsibility dissolved. The structure absorbed the loss and moved on. Investors were not naive. Many suspected failure, but they also understood asymmetry. If the machine failed, they lost money. If it succeeded, even briefly, the upside was total dominance. Energy underpins everything. That imbalance justified ignoring probability. The math of risk was overwhelmed by the scale of the imagined reward. Institutions reinforced this behavior unintentionally. Patents legitimized claims without validating them. Courts punished fraud but tolerated exaggeration. Media amplified novelty while minimizing correction. Each layer allowed belief to persist without requiring truth. Even rejection helped. When science said no, the idea gained identity. It became contrarian, outsider-funded, anti-establishment. That posture attracted a different class of investor, one motivated less by returns and more by disruption narratives. The crucial insight is this: perpetual motion was never a single claim repeated endlessly. It was a flexible framework that adapted to whatever environment surrounded it. When science demanded proof, it offered complexity. When courts demanded clarity, it offered ambiguity. When institutions closed ranks, it moved to the market. When markets matured, it moved online. The machine itself was disposable. The story was not. This is why exposure never killed it. Debunking addressed the device, not the incentive structure. As long as people could profit from being early, exclusive, or visionary, impossibility remained irrelevant. Perpetual motion survived because it promised not energy, but exemption. Exemption from limits, from scarcity, from competition, from history. It sold the idea that one breakthrough could reset the rules for everyone else. That promise was the product. The machine was just packaging. Once this is understood, the centuries of failure stop looking mysterious. They look inevitable. The question was never why the machines did not work. The question was why anyone needed them to. The story ends where it should have ended centuries ago, not with a machine, but with a ledger. Every recorded attempt at perpetual motion reached the same conclusion when stripped of language, ceremony, and hope. Energy in equaled energy out, minus losses. No exception survived independent measurement. No device crossed the boundary that physics defined. The outcome was uniform, repeatable, and final. And yet the investments never stopped. This is the last piece that completes the picture. Perpetual motion was not an error that persisted despite evidence. It was a rational behavior inside a distorted incentive system. Investors were not betting on machines. They were betting on timing. The winning condition was never long-term operation. It was being early enough to sell belief to someone else. Patents could be sold before testing. Companies could be valued before verification. Media attention could be monetized before collapse. In this system, the optimal strategy was not success. It was delay. Delay allowed capital to circulate. Delay allowed narratives to compound. Delay allowed responsibility to fragment. By the time failure became undeniable, ownership had changed, money had moved, and attention had shifted. Losses were real but uncoordinated. No single moment forced collective recognition. Science could not compete with this structure. Scientific truth arrives slowly, requires consensus, and produces no exclusivity. Perpetual motion offered the opposite. Speed, secrecy, asymmetry, one winner, many losers. That imbalance is attractive regardless of probability. The machines themselves were irrelevant. They could be wheels, magnets, fluids, software, or simulations. The form did not matter. The function was always the same. Convert uncertainty into leverage. Once institutions understood the physics, the game moved elsewhere. When patent offices closed one door, marketing opened another. When courts demanded proof, claims softened. When experts explained limits, promoters shifted audiences. Each adaptation preserved the core transaction. This is why exposure never ended the pursuit. Each debunking addressed the claim, not the business model. As long as belief could be sold before verification, impossibility remained profitable. The final irony is that perpetual motion did succeed in one sense. It achieved continuous operation, not as a machine, but as a mechanism of capital flow. Money entered, money exited, losses dissipated. The cycle repeated without end. There is no mystery left, no hidden breakthrough, no suppressed discovery. The laws of physics held. What failed was not understanding, but restraint. Perpetual motion was the most beautiful lie science ever rejected and finance repeatedly rewarded, and that is why, even after every equation is settled and every device dismantled, the idea never truly stops moving. If this story feels familiar, it should. Perpetual motion did not vanish when science proved it impossible. It simply changed names. Today it appears as devices that promise limitless efficiency, algorithms that claim to extract value without cost, and systems that insist constraints are outdated. The language evolves, the structure remains. The lesson is not that people are foolish or that investors are ignorant. The lesson is that belief is often more profitable than truth, especially when truth imposes limits. Markets reward optimism long before they reward verification. By the time verification arrives, incentives have already been paid. Science did its job. It measured, tested, and closed the question. What science could not do was regulate desire. The desire for exemption from scarcity is older than any equation. It does not disappear when disproven. It waits for a new container. That is why the history of perpetual motion matters. Not because the machines were impressive, but because the pattern was durable. Whenever a claim offers total disruption, infinite upside, and minimal accountability, the same dynamics activate. Complexity replaces clarity. Delay replaces proof. Narrative replaces measurement. Understanding this history does not make future deceptions impossible. It makes them easier to recognize. The moment a promise relies on being early rather than being right, the outcome is already known. The moment verification is postponed indefinitely, the machine has already failed, even if it is still spinning. Perpetual motion never worked as physics. It worked perfectly as a warning, and like all good warnings, it keeps repeating itself for those willing to listen.